Well, first up, let's introduce on the show then Arvind Rao. He's a CFP as well as a CA and the founder of Arvind Rao and Associates. Mr. Rao, thank you so much for taking our time today and talking to us on the Money Show. So to start with, Mr. Rao, how important is it for individuals to assess the ancillary costs involved when they invest their money in different asset classes like equities, fixed income, etc.?
Mobina, it's very important because normally the returns is something that investors generally look at and seek, and that's like the rosy picture of it. But as we say, every coin has the other side. So along with returns come the cost for each investment that is made. And unless, so it's not that these costs are going to be every time a huge dent, but it makes utmost sense that someone, every investor keeps a little eye on these costs so that they can be in under check as far as possible.
So explain to us then, what are the different kinds of costs? Let's talk about the equity part first. As we know, you can invest directly in individual equity shares, or you can invest in equity mutual funds. So what are the different costs involved in that journey?
Okay. So for the sake of this conversation, I'm going to borrow the way you introduced this concept, which is there are two types of costs broadly. One is what I'd like to call it as the transaction cost. And second is, let's call it as the maintenance or the holding cost for these investments. So when we talk about equity, let's first talk about investors who are directly investing in shares. So transaction costs are quite a few, which just to count in addition to the brokerage, you have stamp duty, the securities transaction tax, the GST on this brokerage. Then there is also this transaction charges that are levied by stock exchanges, which as a percentage, when you look at, may not be substantial because as we speak, these transaction charges are something like a 0.003%. And then there is also a SEBI turnover charge, which stands at like 0.0002%. So definitely these costs are very minimal. But I have had experiences when people who have been very active in terms of their equity investments, at the end of the year, when they look at their transaction statement, which shows them the various transactions done, and when they keep an eye on the cost, they sometimes wonder whether, these costs probably were never in the realm. And depending upon the volume of transactions done on the share market, these costs could, because they are directly levied as a percentage on the price or the amount that is traded, these costs could pile up as the volume keeps piling up. Talking about the other side of investing in equities, which is via mutual funds. So, transaction costs are minimum there because for a mutual fund investor, today there are no entry loads to any funds. But not to forget, from an exit perspective, there are certain exit loads for certain schemes which kicks in if these redemptions are done before a stipulated period. So, for example, since we're talking about equity funds, most equity funds have a 1 year period up to which exit loads are levied, beyond which there are no exit loads. Mobina, let me also continue talking about the holding cost for the equity class. So when it comes to stocks, obviously you require a demat account where these shares can be held, especially if you are not a trader and you're looking to stay invested in these stocks. So when there is a demat account, there are charges that are levied by the demat accounts, which is a fixed kind of a charge that they levy. And speaking of which, whenever a new stock enters or exits the demat account, there is also a transaction charge that is levied by the depository participant. Talking about mutual funds in terms of annual cost, yes. So all this is combined in a bouquet, and together it is called as the total expense ratio. This component bundles everything, which includes right from the distributor fees, the asset management fees that are charged by the AMC, the registrar and transfer agent fees, the custodian fees, the audit fees, marketing fees, all of this forms the TER, which is built into the NAV and is charged to the scheme. This is what becomes the main component for expenses under the equity mutual funds.
All right. So, let's talk about that whole, the DMAT bit and the individual share trading bit, like you mentioned. In this last 5 to 6 odd years, of course, direct share trading has firstly become quite simple and secondly become cheap as well, because we have all these new platforms that have come by which charge zero brokerage, minimal fees or flat fees, etc., regardless of the size of the transaction that you are conducting. However, in which cases do you think that individuals should not opt for it? Because I'm going to club it with direct mutual funds as well, because when I'm buying direct, I cut off one more layer of expenses. But when do you think it's worth paying all of those fees, and who are the ones who should opt for such fintech platforms?
Yes. So, Mubina, while you club these questions, I'm going to answer them separately. So when it comes to these fintech platforms on which are more popular for the equity share segment of investment, in my view, it makes ample sense for those investors who do equity trading in good volume. Probably, I don't want to use the word day traders, but then there are people who do sizable amount of equity trading, and it is in these cases, since these platforms offer in some cases zero brokerage or even a very, very small amount of fixed brokerage that they levy. At the end of the year, for these large volume traders, these platforms help in lowering their transaction costs, which will give a boost to their overall returns that they have earned on their shares. But a small thing here is that on the other side, for the smaller investors who are probably not much into volume trading, but may end up buying, let's say, maybe shares once or twice in a month, or maybe once or twice in a quarter, as infrequent as that, for them, they may still not necessarily look at these platforms because I'm just gathering experience from conversations that we have with people. So one of the reasons these platforms are able to provide such low cost transaction costs to their investors is that since they are fintech, there is a possibility that they don't have a very robust servicing team behind them. So for people who are not very conversant with the equity markets, who feel that there may be stumbling blocks when they actually get into the process of investing, and they need a proper support team, they need someone who they can pick up their phone and talk to. In such cases, they may still go with the traditional options available. And drawing a same analogy to their second question, which is for mutual funds. Now, over the last, I guess it's almost 6 to 7 years, there has been a lot that has been written about and is still being written about is about the direct equity, direct plans in the mutual funds. So for the viewers here, definitely direct plans are a boon, because when we talked about the total expense ratio for mutual funds, the distributor fee is one component which is missing when you compare the direct plans to the regular plans. So when you are investing in a direct plan of a mutual fund, you save your cost, which is the distributor remuneration that is deducted from your investment. But this is more suitable for people who are very avidly following markets, who are like regular viewers of channels like ET Now, who know where they have to invest, how they have to invest, how much they have to invest. If they have answers to all these questions, then direct plans make ample sense for them, because all they are seeking is a transactionary support in terms of getting the investments executed. So for them, direct fits well. And then you also have a lot of these investors who don't have the bandwidth or who don't have the inclination to follow these channels or to read papers and know which funds to buy or which stocks to buy. For them, I think the regular plan still holds good because while the TER for mutual funds has been coming down, the regulator has been quite proactive in bringing down the expense ratios for these schemes, which in turn has brought out the distributor commissions also down. So, but still, having said this, there is a good amount of difference between investing in a direct plan versus a regular plan.
To ask you one more question then on okay, very quickly, let me just ask you one more question then, and that is on the costs involved in other asset classes, gold, real estate, etc. How would you sort of summarize those? If you could explain that for our viewers.
Sure. So let me also talk about real estate, because I think that is one area where people generally look only at the price at which they buy the property and the price at which they sell. But then there are a whole lot of costs that are incidental to this transaction, namely the stamp duty, registration, brokerage, and of course, not to forget the interest that is paid on the home loan that you take. Now, these interests being cumulative over the period that this property is held, the interest cost can be quite prohibitive. So while you look at the entry price and exit price, and that looks lucrative, don't forget to deduct these costs incidental. And speaking of which, in real estate, the holding cost, which is by way of insurance that you have to pay for your property, the society maintenance, the repairs, property taxes, all these can be a deterrent for looking at real estate as an investment. And one has to be mindful of all of this before they take a plunge. So also for gold, I mean, of course, there has been a lot of changes in the way you can invest in gold. Talking about gold ETFs and the recently, the new option that is available is the sovereign gold bonds. All these are riding over the one main cost and risk of investing in gold, which is if you are holding physical gold, you need to have an access to a locker where you can store all this, which implies there is a locker charges. And on the other hand, the safety part, to protect this gold from being being lost to theft, all this is avoided when if you look at things like the sovereign gold bond or even the gold ETF.
Yes.
So these transaction costs, I think, in the other asset classes are far more simpler.
Okay. Yeah, that's true. And, just how, in fact, we have paper gold, we have paper real estate also in the form of REITs. But we'll keep that conversation for some other time. Thank you so much, Mr. Rao, for joining us.
It's been a pleasure.
And we'll have to take a very short break, but we'll be right back with more.